Hey, what's going on, everyone? Welcome back to another episode in my Crypto 101 series brought to you by Crypto.com. I just want to take a minute to talk about them and show my appreciation for them sponsoring all of this free educational content. Their app is actually pretty awesome. I love their credit card. It's actually a debit card. I use their debit card quite often. So if you want to check it out, there's a link below. You can sign up and you get free money under my referral link. So today I'm going to talk about portfolio diversification, why it's important, why you should avoid large drawdowns, and why going big into one asset is not necessarily a good idea over the long term. It's not likely to work out and be sustainable over a career or over a lifetime. So first off, I really just want to talk about P&L curves, drawdown, because the biggest thing is to avoid large drawdown of our account. Now, sometimes that can hinder our upside a little bit. We won't see as steep of an upside curve, but it's much easier to manage small drawdowns over the long run than large drawdowns and having to try to figure out how to make those gains back. Let's just take a look at the gain required to make up for a loss. So you see here, if you take a 10% loss, you only need an 11% gain to make up for that loss. And that's, again, overall portfolio. But once your losses start to become bigger, you can see it takes a lot larger gain to make up for that loss. So if you have a 50% drawdown on your account, you now need to make 100% profit to get back to break even. So if an asset is at $10 and you buy it with your whole account, it goes down to $5. You now need something else to gain 100%. You need that to go all the way back to $10 to make back that loss. Growing your portfolio 100% is a lot harder than losing 50% of your portfolio. So risk management is definitely key, and this is the whole reason for this video and why we talk about diversification. Small valleys in your overall P&L curve are much easier to conquer than large divots, large dumps, the emotional toll they take, and just the difficulty it is to consistently find 50, 100% profits, especially if you're going all in, is just unsustainable and almost impossible. So this is an example of a P&L that is very harsh and strong and steep, and you can see that there's really no risk management, no strategy here. It's just large upside and then large drawdown, large upside, large drawdown, and it's very uncontrolled. And this is very unsustainable, okay? And a lot of times what you're gonna see is at the end of these cycles, this account basically goes to zero, and once it's at zero, it's almost impossible to grow, right? Because at that point, you're like, oh, well, there's nothing left in here. I'm not going to use risk management. I'm going to throw risk management out and I'm just gonna go big, and you might have a couple wins here and there, but it's basically gonna flatline and it's not gonna be sustainable. Now, this is no diversification, all right? This is no strategy, no risk management. It's just go big or go home, and eventually you're usually going to go home. You can be in the best fundamental position ever, and there could be a legal issue with a stock or with a crypto asset. There could be a rug pull or, a bug in the contract or anything. And even if you're in a great position and fundamentally it's strong, there are always conditions that are out of our control. And you never know when something is going to happen that's going to just completely ruin years or months or whatever it is of upside, okay? So this is why we diversify, and this is why we control our drawdown, because it's much easier to grow an account that has capital left in it. Now, this is what a well-diversified portfolio will most likely look like over time with a positive risk management strategy, all right, and strong diversification. Why? Because we're limiting drawdowns. If one of our positions completely goes to zero, you can see we're not taking a huge hit. Now, this is more likely to succeed in the long run. You're more likely going to be in profit, the whole time. And of course, you can have some drawdown initially, but eventually you're going to have some big runners. Eventually, you're going to have a really strong push where a lot of positions are doing really well. You're going to hit a big winner that does 1,000% or something, and that's really going to propel your account, all right? Now, that's why we let our winners run, but those aren't going to happen all the time. Those are few and far between. And when they happen, you want to make sure that those profits are protected because otherwise you're going to just see that sharp up and down, right? And not only that, but market conditions are going to change as well. So you can see here, all right, maybe we had a very strong market right here and we just mega spike, okay? And which will happen. But for the most part, it's nice, steady gains. You can see we have prolonged period of drawdown here, and that's totally fine. Drawdown will happen, but as long as we're limiting our drawdown, you can see we're still well above our previous all-time high over here in our previous sideways market, basically. So the key here is to avoid those large drawdowns, easier to take emotionally, and diversification is going to provide this for you by if one of your positions does very bad, you're protected, right? Because eventually one of your positions is just going to get knocked out of the floor and it's going to be a terrible position. And that's why we have diversification of assets to limit that overall downside risk on our portfolio. If you only have 5% in a position, that basically goes to zero. Your account's only down 5%. If you have 50% in a position, that basically goes to zero, well, your account is now down 50%, right? And it's just sometimes out of your control. And I'm telling you, it will happen to you eventually. You will have a big loser, and you want to make sure that big loser is not devastating to your overall portfolio. So you're going to see this graphic here, and this is basically showing a well-balanced portfolio, right? A nice diversified portfolio where you're putting it in different assets, different asset classes, and you're not trying to outperform the whole market. You're just trying to not see as much drawdown as part of the market. All right. And basically what this is showing is you can see the black line here and the balanced portfolio, and it's never the worst performing portfolio. If it's well balanced, well diversified, there's certain asset classes that'll have really big years and certain asset classes that'll have really bad years, right? And the reason we do this balance is because you can see here, most years, it's in the top half of performance. In some very few years, it's in the bottom half of performance. But the key here is sustainability over the long run. You can see it's never at the bottom for performance. And a few times, you're going to have those big years, those big upside moves. And a couple years, it's actually at the top of performance or, the top 20%. I really love this chart as a very good visual interpretation of how a well-balanced portfolio, well-diversified, can sustain you over the long term, even if certain areas of your portfolio have large drawdown. Overall, you should be protected, and there's always going to be some asset classes that are positive while others are negative. Buy on the way down, or buy as things are red or beat up, and sell as they go up. If you start getting into a small position and it's underperforming and it's going down, and you have another position that's doing well, maybe you take some funds from this position that's already up a large percentage and you start shoveling them to this asset over here that's down. And as this, inevitably starts to sell off, you've already taken some profits, your portfolio has increased, and now this one, which is beat up, is now starting to slowly increase. And so now you're not losing as much unrealized profit, right? Because you've realized some profits. And in here, you're actually gaining profit now because you have added to that position as it was down, and now you're seeing it start to move up. And then so as that position starts to move up, you could consider taking some profits from that and going into another laggard of your portfolio and saying, okay, this is pretty beat up. This looks like it's due for a bounce here. And if you're getting into fundamentally strong projects, of course, they're going to have some bear markets, but over the long run, right? Over the long run, they should come out of those bear markets and go into bull markets. So that's basically what you're trying to do here, is not really time a top or a bottom. You're just trying to diversify into, getting out of very, very strong assets as they're exiting their bull market and getting into very weak assets as they're entering their bull market. The key is just to never really overexpose yourself into any one asset. And you should also understand, the risk involved with these assets and the percentages involved. If you buy something that is $1,000 a share, 1% move is a lot different than if you buy something that's $1 a share. All right. Not only that, the market cap comes into play. So if you buy a $2 million market cap crypto, over a $1 billion market cap crypto, the percentages are going to swing heavily. So you're not going to want to put a large percentage of your portfolio into these high risk assets, the low market cap assets that one buyer or seller can change the whole outlook and the whole price, right? So you need to understand, and I actually have a video for this, which you can check out here. I will put a card for it. So understanding which assets are high risk versus lower risk assets, you're going to want to put more of your account and diversify more heavily into these lower risk assets. Like Bitcoin would be considered a lower risk asset as far as crypto is concerned, because, you know, if Bitcoin does a pullback and it goes down 5%, many altcoins will go down 20 or 30%. And that's why you see so many people with large drawdowns on their account, is because they go extremely heavy into altcoins, and altcoins drop 50% in a month, whereas Bitcoin may be only down 5 or 10%. So understand high risk assets, understand taking profits, periodically shaving profits, because unrealized profit doesn't mean anything. All right. Learn how to cut your losses early. If you have a laggard in your portfolio or something that's just really not performing well at all, maybe it's not even worth adding to and just cutting completely, and either finding a better entry on it or just scrapping it altogether. I really hope that you guys learned something from this video. If you don't mind subscribing to my channel, I appreciate it. Of course, a retweet on Twitter is also appreciated. I'm going to keep the free education coming for you guys. So stay tuned for more, and I will catch you next time. Peace.